Buying a home is emotional, but buying an income property is financial, and the escrow process is very different. In an income property transaction, you're not just buying a building, you're buying cash flow, leverage, and risk. Deadlines tighten, numbers shift, money gets committed. Income property escrow is where capital gets tested, and today we'll walk through how disciplined investors protect it. You've been looking at deals, you've run numbers, you've passed on properties that didn't quite meet your standards, and finally, you find one that makes sense. The income supports the debt. The debt coverage ratio clears lender minimums. The cap rate meets your threshold. The follow along calculator confirms the spread. This isn't excitement, this is discipline. The deal qualifies, so you make an offer and the seller accepts. And now you're ready to open escrow. And once escrow opens, everything will change. The seller has accepted the offer, the price is agreed, the deposits are defined, the closing timeline is set. At this point, the deal moves from negotiation to execution. Escrow opens, and once escrow opens, the tone changes. Before this moment, everything was projection, income assumptions, repair estimates, financing expectations. But now those assumptions begin to get tested. Escrow is where the deal is verified, and that's where capital is either protected or exposed. This is the capital transition phase. Escrow is a transition phase. You enter escrow with projections, expected income, estimated repairs, assume financing, and then during escrow, these assumptions are tested. Inspections verify condition, documents confirm income. The lender applies underwriting standards, and when you exit escrow, you're no longer operating on projections, you're operating on verified reality. Your job during this phase is simple: protect your capital while the facts are revealed. A contingency is simply a protection clause in your contract. It gives you the right to cancel if certain conditions aren't met, like inspections, financing, or document review. Until those contingencies are removed, your deposit is usually protected. Contingencies exist to preserve your capital while you verify the deal. Once escrow opens, the contingency clock starts. These deadlines aren't suggestions, they're your protection windows. You have a defined number of days to inspect, verify income, confirm financing, and review the appraisal. If you don't act within those windows, your protection weakens. Contingencies only protect you if you use them on time. Once escrow opens, you start spending money. You hire the property inspector, you order the termite report, the lender charges you for the appraisal. You're out about $3,500, and that's not refundable. You've also wired your $30,000 deposit in, and that's protected during the contingency period if you cancel properly. So now you have over $33,000 committed, and only $30,000 is recoverable. No matter what happens next, you're in for $3,500, and that's when the psychology shifts. Once money is committed, the psychology changes. You've told your spouse, you've mentioned it to your CPA, you've pictured owning it, and you've imagined the cash flow. The deal isn't just numbers anymore, it becomes part of your identity, and that's when your discipline gets tested. In the business, we call this the second bite of the apple. You've already agreed to buy it, but you still get one more look before it's yours. This is your verification window. You walk every unit, you compare the leases and estoppels to what you were told, you confirm the operating statements line up. You're not there to take ownership, you're there to take inventory. And this is where you make sure the apple tastes the way it looked. And you want that clarity before your contingencies are removed. The inspection didn't kill the deal, but it changed the math. We uncovered about $17,000 in repairs. Insurance also came in about $200 per month higher than projected, and that compresses cash flow and tightens coverage. So we respond strategically. We request $17,000 repair credit and a $15,000 price reduction. The goal isn't to win the negotiation, it's to restore margin, protect cash flow, and maintain disciplined entry standards. When the numbers move, we adjust or we walk. The seller accepts the counteroffer. The repair credit and price reduction restore much of our margin. The ratios are tighter, but they're still within our standard. With the deposit confirmed, the walkthrough completed, and insurance verified, we release the first three contingencies. The deal moves forward. The protection window is narrowing and discipline matters even more. Now the focus shifts to underwriting. You've released the first contingencies. Underwriting is still in motion. The appraisal is pending. The bank is recalculating the coverage based on the revised numbers. They're verifying leases, estoppels, and the trailing 12 months income. Approval is not yet in hand and the clock is running. The appraisal contingency is 17 days. The loan contingency is 45. If approval doesn't come through in time, you have a decision to make. This is day 17. Inspections are complete, repairs have been negotiated, insurance is updated. The appraisal has been submitted, but final approval is not yet in your hand. You have $33,500 committed. $3,500 of it is already gone. The appraisal contingency expires today, and the loan contingency runs to day 45. So the question becomes, do you remove the appraisal contingency? Do you ask for an extension, or do you step back? Let's look at what happens if you have to cancel. At day 17, you technically have the option to cancel, and if you do, your $30,000 deposit is returned. You lose roughly $3,500 to third-party costs. The deal ends. But in real transactions, this is rarely where deals die. Lenders are often still working, appraisals are pending, so instead of canceling, you may remove the appraisal contingency and continue to the 45-day loan contingency. That's your real decision window. By day 45, underwriting is clear. Everyone is deeper into the transaction. Adjustments get made. Most deals either finalize or clearly fail at that point. Canceling now protects capital. Continuing preserves opportunity. And you've got to remember, more wealth is built by owning real estate than by standing on the sidelines. As escrow moves to closing, the math settles. Property taxes, rents, deposits, and utilities are prorated between the buyer and the seller. Depending on timing, you may owe funds or receive credits. At the same time, you must bring in the balance of your down payment, along with any closing costs and any net adjustments. Escrow provides a final settlement statement that shows exactly where every dollar goes. And this is the final capital commitment before ownership transfers. Now let's look at who gets paid before you do. At closing, money flows in a very specific order. First, the lender funds the loan and collects the fees. Escrow and title are paid. Inspectors and third-party reports are settled. Brokers are compensated. The seller receives net proceeds, and only after everyone else is paid, you become the owner. You're at last in the payment chain, and that's the reality of capital deployment. Ownership begins after all obligations are satisfied, and then escrow closes. Escrow closes. The settlement statement is finalized. The grant deed is recorded. Loan documents are executed. Keys are delivered. Management takes control. Ownership is now official, but closing isn't the finish line, it's the starting point. Mortgage payments begin. Operating expenses continue. Income must now perform. Execution created ownership, but performance will determine the result. Most problems in escrow don't come from inspections. They come from overpaying. When you stretch on price, you remove your safety net. Debt coverage tightens, cash flow compresses, pressure increases. Disciplined investors operate differently. They refuse to stretch on entry. They require ratios to clear with room to spare. They build margin before emotion sets in because margin protects discipline. Escrow is where capital gets tested. Deadlines tighten, numbers move, pressure builds, and emotion tries to take over. The outcome of that pressure isn't decided during escrow. It's decided before you ever open it. The strength of your entry determines the calmness of your exit. If you want to practice that discipline before you ever wire a deposit, I left a link in the description so you can download the calculator and run your own deals. Because real investor protection starts at the entry, not at the closing table. I'll see you in the next lesson.